Hi once again to all our fixed income clients. Another quarter has passed and it's time for another For Your Interest publication. One thing that's evident to us another quarter down the line is that we still are nowhere nearer exiting the unprecedented policy that we have of zero interest rates in the developed world, rising inflation and no growth. And this is causing a huge amount of uncertainty for fixed income investors. One of the most high consensus trades in the fixed income market at the moment is that US bond yields need to rise as the Fed normalizes policy and the US economy recovers. And while we share this sentiment, we are not as convinced as the market is that this is an inevitability. And so in our first article this quarter, we look at a slightly contrarian view of what if the Fed doesn't normalize policy, and what if US rates stay at zero for an extended period of time? This is not that an unrealistic scenario to us, and we need to consider the implications for South African fixed income markets, particularly if this eventuality pans out. So read it with an open mind, and if you share our views, we'll raise some of the flags and triggers as we go along if that eventuality does indeed pan out. If global uncertainty is not enough, we're sitting with uncertain monetary policy reaction functions around the world, and our own monetary policy committee falls into that camp. As a fixed income investor, it's absolutely vital to have a view on what the repo rate does going forward, because that will inform the returns and the performance of all other fixed income asset classes. And so in our second news item, our strategist Bulent Budger takes a look at monetary policy in a very difficult environment, one of rising inflation but falling growth. And he looks at this under the new policy regime of flexible inflation targeting. This is a controversial policy regime, but one that looks like it's becoming more entrenched globally. And then our third and consistent theme for the last couple of newsletters has been investing in credit. Generally, investors shun high-yield credit or associate high-yield credit with more risk and something that should be avoided. And we've consistently made the point, and we do again this quarter, that high yield doesn't necessarily mean higher risk that should be avoided, but often offers exciting and attractive investment opportunities in what is still a very low yield environment, and we look far and wide to squeeze out extra yield and extra return for our clients. So I hope you enjoy this quarter's publication, and we continue to navigate fairly choppy and uncharted waters in fixed income markets.